that central banks around the world are looking to buy more and more gold over this year and the coming year. They've been buying over 1,000 net metric tons a year for the last 3.5 years. And yes, they're abandoning the dollar as not completely, but they're hedging their bets with gold because gold is not political. Gold cannot impose sanctions on you like the United States and Europe as well, for that matter, have been doing, especially to Russia in the last few years. So I think gold and silver and commodities are still the place to be in the medium to long term.
At the 2025 BRICS summit in Rio de Janeiro, Russian President Vladimir Putin confirmed that 90% of transactions among BRICS members are now conducted in local currencies, with a significant share settled in rubles. President Trump responded with a warning that any country aligning with BRICS anti-American policies would face a 10% tariff without exceptions. This escalating tension reflects a broader transformation in global finance. Mario Innecco, a former city banker and contrarian economist, has observed central banks worldwide increasing their gold purchases in 2024 and beyond, continuing a trend of accumulating over 1,000 metric tons annually for the past 3.5 years. Global central banks bought a net 20T in May, close to but below the 12-month average of 27T. Fresh tensions in the Middle East may have reinforced the strategic appeal of gold for central banks looking to safeguard reserves against geopolitical shocks. This continued interest was highlighted in our recently released Central Bank Gold Reserves Survey 2025. Mario explains that central banks are not abandoning the US dollar but are hedging with gold, an apolitical asset that cannot impose sanctions. This strategic shift represents a fundamental recalibration of reserve management practices, driven by geopolitical considerations rather than purely economic ones. He views this as a direct response to Western sanctions, particularly those imposed on Russia since 2022, which have exposed the risks of holding dollar-based reserves. Asia is progressively moving away from the US dollar as geopolitical uncertainties, monetary shifts, and currency hedging prompt de-dollarization across the region. Recently, ASEAN committed to increasing the use of local currencies in trade and investment as part of its newly released Economic Community Strategic Plan for 2026 to 2030. Before we begin, don't forget to like and share the video with friends and fellow investors. Subscribe and hit the notification bell to stay up to date. Your incredible support is what keeps this community thriving and growing stronger every single day.
That central banks around the world are looking to buy more and more gold over this year and the coming year. They've been buying over 1,000 net metric tons a year for the last 3.5 years. And yes, they're abandoning the dollar as not completely, but they're hedging their bets with gold because gold is not political. Gold cannot impose sanctions on you like the United States and Europe as well, for that matter, have been doing, especially to Russia in the last few years. So all the talk of punishing countries that deal with BRICS or even countries that are in BRICS, I think is going to have the same impact that freezing Russia's assets had back in 2022. It's going to push foreign sovereign countries more and more into gold as a reserve asset. They're going to look more and more into dealing with other nations without the US dollar. And what that's going to mean is that they're not going to have as much dollars to park in the treasury market. And that's another reason why US banking regulators and the US Treasury are pushing for the loosening of the statutory leverage ratio, or SLR, for the major US banks so that they can load up on more treasuries, because Uncle Sam, of course, has got trillions upon trillions to refinance. And if they don't find a captive buyer, rates are going to have to go higher. Yields are going to have to go higher. That's how you attract attract buyers in a bear market if you can. Some people might think, well, they get rid of this SLR, they'll allow the major Wall Street banks to buy loads of bonds. Yes, they could do that, but what that's going to do as well is that's going to free up a lot of liquidity, which means more currency out there floating around. It's going to be even more inflationary. So I could see it backfiring. And I guess one thing that they could resort to, especially the Federal Reserve, is to not more QE, because right now they're doing QT. They'll have to stop the QT and then start QE again. But that's going to put a rocket up gold, silver, and all other commodities. So I think we're going into some very interesting times, and not that it's going to be great for everyone. Unfortunately, the people who are going to suffer the most are going to be the poor, the lower quintile of income earning people, or as the British say, the lower classes, the working class. They're going to suffer. The middle class is going to suffer. Maybe the 1%, they won't suffer because they have the assets and they have enough hard assets as well to protect themselves. The government, of course, they're not going to suffer. They're going to keep operating. And the other thing that's really making things even more interesting is that I think this tariff war, this trade war, could evolve into a kinetic war. And I think that's the way things are going.
Despite the longer-term accumulation trend, precious metals markets have shown typical volatility in recent trading sessions. Mario also notes that earlier in the day, gold and silver experienced sharp drops but had recovered by midday in New York. Gold fell to $3,296 before rising to around $3,321, down just 0.5%, while silver bounced from $36.14 to $36.70. The current market environment reflects ongoing uncertainty about policy directions under the new administration. The gold price is back in the red, trading below $3,350 early Tuesday, remaining stuck in a familiar range since last Friday as investors assess the implications of the latest tariff threats by U.S. President Donald Trump. Silver's technical picture shows similar consolidation patterns. Silver has been trading within a $2 range over the last 4 weeks, but recent price action indicates an ascending trend from the lows reached in late June. Although the resistance area at $37 remains holding, bulls are closing in on the $37.25 long-term high. Despite these short-term moves, Mario maintains that gold, silver, and commodities remain strong medium to long-term plays, even amid short-term fluctuations. Let's get back to the video.
I think the bond markets don't look good. I think it could spill over into the stock market in that we could see the stock market kind of top. Yes, a melt up is still possible, but there's something brewing in the system right here. And of course, the Fed only meets at the end of the month. We could see them cut rates and start cutting more. I think the Trump administration is really pushing Jay Powell towards rate cuts, and we're seeing some other governors calling for rate cuts. And that doesn't necessarily mean things are great. A lot of times when the Fed starts cutting rates, it means that they're concerned. So watch out. So right now, for example, we saw gold and silver get hit pretty hard earlier today on Monday, but as I speak here, it's like midday New York time, 6 p.m. Swiss time, and gold is still it's down 0.5% at 33.21, but it traded as low as 32.96, so it's recovered. Spot silver traded as low as 36.14, but we're now at 36.70. So I think gold and silver and commodities are still the place to be in the medium to long term. I see the stock market, the rally we saw earlier today has fizzled out. The Dow futures is basically unchanged. S&P is up about 14 points, and the NASDAQ 100 is up about 60 points. And as I said, the bond market, as I speak here, the 30-year yield, for example, is at 4.92. That's up 6.5 basis points, which, isn't a great move, but it's a significant move on a day where things are pretty quiet. But As I said, the curve is steepening because the 2-year yield is up only 1.5 basis point. The 10-year yield, that's up 7 basis points at 440. So we need to keep an eye on that. We've got the stock market at all-time highs. We've got the the Warren Buffett indicator of stock market capitalization to GDP at all-time highs. We've got commodities going also through the roof, so to speak. Things like copper, gold, silver breaking out to 12-year highs. And I think investors, they're concerned, especially in the longer end of the bond market. And also with all the talk that the Fed's going to cut rates like 3 times this year, I think the bond vigilantes are worried. And there's also the geopolitical situation that is getting worse in terms of the conflict between Trump, the US, and the rest of the world. Trump, I think, posted on Truth Social over the weekend that he was going to punish any country that dealt with BRICS, like put a 10% extra tariff on BRICS. The other thing that shows me a sign of weakness. Many people have dismissed the BRICS, that it's not important. But for Trump to be concerned about BRICS, I think it shows that it is important. And I think this is going to act as incentive to the BRICS nations and the rest of the world that's trying to join BRICS to de-dollarize even more. They're going to say, we can't really depend on doing trade with the US if they're going to be that difficult.
Gold's price outlook remains tilted to the upside over the next 18 months, while silver and platinum are expected to maintain their upward momentum through 2026. Both gold and silver continue to show resilience amid ongoing market uncertainty. Despite short-term volatility, they remain supported by rising concerns over bond market instability, potential interest rate cuts, and broader economic risks. With inflationary pressures and geopolitical tensions persisting, gold and silver offer long-term value and protection, positioning them as key assets to watch in the shifting financial landscape. Can silver take the lead over gold and emerge as the top performer in the metals market? Drop your thoughts in the comments below. If you found this video valuable, please give it a like, share it with others, and don't forget to subscribe. Help us grow this community and stay informed with the latest updates.